We have Sidhanshu Jain, the CFO, joining in on the show right now. Sidhanshu, hi, morning. Great to have you. And what a big buzzer this is today. IDFC First reacting to your numbers. And you've managed that 20% loan growth in the first quarter. How sustainable is this pace, Sidhanshu, through FY27? And what loan growth should we expect for the full year?
Yeah, thanks, Ayesha, for the question. And good morning to all the viewers. On the loan growth, if you ask me, the business momentum currently is very strong. We see that this 20% is quite sustainable. In fact, on top of it, we also see some opportunity which could come out of FCNR. So we feel that the business momentum across various asset classes is quite strong. Our bulk of the growth has been coming from mortgage, corporate banking, business banking, vehicles, gold, and so on. So we have been powering all of these segments. So we feel quite confident. Of course, we are also cautious of the macro environment, which could play out. But net-net, we feel this is quite achievable.
Good to hear that. What about Treasury income, though? That contributed meaningfully as well this quarter. If bond yields were to reverse, Sidhanshu, from here, should investors expect Treasury to become a drag again for you?
Yeah, so this quarter we had a good run. The 10-year yields softened by about 28 to 30 basis points. So we were able to capitalize on that. So our trading teams took a view and we were able to garner this kind of a gains. So depending on the yield movement, we keep shuffling our positions, right? So that we don't end up with a big loss if the yields have to reverse meaningfully. So we closely monitor this, but we are hopeful that we will be able to maintain a steady set of numbers on this front as well.
Sidhanshu, give us a sense of the ROA, return on assets for you. It went up in the first quarter on the back of treasury gains and income tax refunds coming in. If you strip that off, it's around 0.9% or so. Will you be able to sustain above 1% or end FY27 above 1% going forward?
Yeah, that's what we are guiding for. That now for the full year, we will try to maintain ROA about 1%. Last quarter, our ROA was about 0.77%, which improved to, as you rightly said, even if we take out some of these one-timers, we have reached already in 0.9%. And we feel that even into the rest of the year, the operating leverage will continue to play out. If you see this quarter numbers, my delta between income and opex is almost 500 basis points. We feel that trajectory could continue. And hence, even this 90 bips, which when we strip out some of these one-timers, could move meaningfully higher. And hence, for the full year, we may be able to achieve 1%. So that's the guidance.
NIMs, though, 5.96% at a multi-year high. But you're guiding it back down to 5.8% for the full year, Sidhanshu. Why is that?
So let me put some numbers here in perspective. If we exclude certain one-time, like interest on income tax refund just got mentioned, right? If we take out that, then the NIM for the quarter was about 5.9%. And for the previous quarter, similarly, if we take out the day count convention impact which had come, it was 5.85. So first of all, sequentially, we have seen a 5 bips improvement in NIMs. It largely came on the back of improved cost of funds. Against this 5.9, in fact, we are guiding for 5.8%. If you recall in the previous call, last quarter, we said for the full year, our NIMs could be about 5.75%, same as the last year. But in fact, now we are increasing the guidance to 5.8%. To the question on why it could slightly moderate from here is because we are continuously changing our asset mix and trying to move more into safer segments, corporate banking, business banking, FCNR opportunity, which some of it could impact NIM, but net-net, the contribution to the ROA could still remain very strong from some of these segments. It's largely because of asset mix change which could play out.
Sidhanshu, the other piece that played out, hi, this is Harsh. The other piece that has played out this quarter is the CGFMU, right? And you've prudently provisioned that number. First off, just give us a sense as to, is there more in the pipeline in terms of those reversals which will come your way? And will you continue to treat it this way? Will you continue to build a buffer provisioning?
Yeah, first of all, on CGFMU, we got this in this quarter. It generally comes only once in a year. Right. So this is for losses which we had taken in the earlier years. We could expect some amount also coming into the next year. because this is largely for disbursements which were done in FY25 and NPAs which have come out of that. While today the asset quality parameters are all holding well. If you go and see, my SMA has improved from 1.01% to 0.77, which is the pre-NPA stage. Similarly, NPA numbers have improved from 1.97% to 1.51%. We have given a fair amount of disclosure across all product segments, and we have seen improvement. But having said that, because of the uncertainty which could prevail, which is this West Asia crisis, some deficit on monsoon which could be there, proactively we have taken a forward-looking approach, and we have made a cushion or a prudent provision in that sense. But the overall guidance also at the same time, we have said that credit cost comes down from 170, 180 basis points, now 150 to 160, all of this baked in. So we feel that all the asset quality could still hold up quite well.
Sidhanshu, you spoke about that product mix will be driving margins for you, and ROAs as well. How do you look at, while corporate loans are expected to grow nearly 30% for you, what about other segments like an SME, MFI, and Agri?
No, so I earlier talked about growth is coming from some of the segments, which is corporate banking growing at a fast pace, business banking, then commercial vehicle, mortgage, and so on. To your specific question on MFI, we in fact now have seen that the book has stabilized and it could grow even into this year by about 15 to 20%. Similarly, on MSME, there are two components of it. One is the secured part of it, which is business banking. That has been growing at a very healthy pace of 27%. We have been slightly cautious on the unsecured MSME, which is a smaller portion, much smaller portion of the book at about 4.5% of total funded assets. There, if you go and see the numbers, the growth has been, in fact, marginally negative during this quarter and about 1% lower in last 1 year because of the noise which we had around tariff, because of the West Asia crisis and so on. So we have been conservative in that sense. But the certain portions of MSME will continue to grow faster, we feel.
Sidhanshu, you did talk about an evolving or a changing product mix. 3 years hence, what's the product mix going to look like?
So retail today, if you see, is about 59% of the book. Then rural is about 7-8% of the book. Then your MSME is about 12-13% of the book, and corporate is about 21%. So we like each and every product classes, I would say, while corporate could take a slightly higher share, which is today 21%, maybe could inch up to 25%. But the rest of the book would essentially be retail, MSME, and the rural book is how we see things could span out from here.
Sidhanshu, trying to understand how OPEX trends play out, right? Because that is one of your key levers on ROA outside of credit cost, of course. Credit cost will eventually normalize, is the understanding. Correct me if I'm wrong. And then the lever will be OPEX. Do we see a single-digit kind of OPEX growth in terms of expectations next 2, 3, 4 years? And will that likely play out on the ROA going forward?
Yeah, you correctly said OPEX will be a very key leverage factor, and we are already seeing that playing out. In fact, cost to income has improved from 73.8% from last Q1 to 70.7%. And if we have put out one number that the operating jaw is really opening up, right? Like income this quarter has grown by 21.5%, whereas OPEX growth has been only 16.5%. So this 500 of bips delta, which we have been able to achieve, we want to maintain this into the rest of the year and even into future years. So this is clearly operating leverage, which is expected to play out. And definitely it will lead to further improvement in cost to income. So we are a growth bank. We want to ensure that as part of this growth, we continue to get this operating leverage.
Sidhanshu, give us a sense of the impact of ECL, what kind of provisioning that you will need, and if because your CET1 is currently around 15% odd, will that impact your CET by the end of the year when you bring that into impact?
Yeah, first one data, I would say clarification, CET1 is 13.33% as of June, and the total capital adequacy is about 15.05%. See, these ECL guidelines come in from April 1, 27. So definitely we will be required to put aside more capital for ECL when this comes up in April. But at the same time, there are certain RWA related changes in the form of reduced credit risk RWA, operational risk RWA, which also come in at the same time. So if we see in a combination, which is ECL plus this RWA changes, then the impact on capital adequacy we feel will be neutral at the time of transition. So we feel that at transition, this is quite manageable in terms of an ECL implementation.
And therefore, Sidhanshu, should one look at a 1% ROA 1.05, which you've done this quarter, as the floor? And does it just keep improving from here in terms of the trajectory? How quickly do you target to reach 1.5? Which quarter, which year?
Yeah, so first of all, as I said, this year also we are now gunning for 1%, right? In the previous calls, we had not guided to this extent, but to that extent, we have slightly increased the guidance. And we feel with the operating leverage playing out, and if we are able to maintain asset quality at certain levels, definitely ROA will not stop here, right? So it can definitely get to that 1.6, 1.7% zone in maybe 3 to 4 years. So we feel track is very clear. Execution, we will ensure that we try to get to those levels.
Okay, Sidhanshu, great to speak with you today, and congratulations on a great quarter once again.
Thank you very much. Nice speaking to all of you.